Welcome back to SkiesCapital, where aviation meets investing. Most investors focus on price, but price alone does not tell you whether the stock is expensive or cheap. What matters is value. Value tells you what you're getting for the risk you're taking. In this video, I will show you a simple way to compare dividend yield and valuation so you can quickly decide whether the stock deserves a deeper look or whether it's one to pass on. It's a simple dividend stock litmus test using just two numbers, dividend yield and PE ratio, and comparing it to the company's 5-year history. As always, this presentation is for educational purposes only. It does not constitute financial, legal, or investment advice. Please consult a qualified financial professional before making any investment decisions. Why compare the last 5 years? Every stock has its own normal range of dividend yield and PE ratio. If you only look at today's yield or today's PE isolated, it's hard to tell whether this stock is expensive, cheap, or just normal. By comparing today's numbers to the 5-year averages, I'm trying to answer two simple questions. Is the stock cheaper or more expensive than its historical range? And has the price moved more than the business fundamentals? This is not a full valuation model. It's definitely not a buy or sell signal. It's just a first pass litmus test to decide, do I dig into this deeper or do I move on to the next idea? Step 1, the dividend yield versus its 5-year average. Step 1 is the dividend yield. A quick reminder, a dividend yield is simply the annual dividend per share divided by the current share price. My litmus test question is today's yield higher than or lower than the 5-year average? If today's yield is higher than the 5-year average, that could be a signal the stock is cheaper than usual. If today's yield is lower than 5-year average, that could be a sign the stock is more expensive than usual. But there are some nuances here. Yield can go up for a few different reasons. The price dropped, the stock price dropped, the dividend yield was raised, or both could have happened at the same time. So a higher yield gets my attention, but I still need to figure out why it is higher. Step 2, price earnings ratio versus its 5-year average. Step 2 is the PE ratio, that is the price earnings ratio. Basic definition for the price earnings ratio is its current share price divided by its earnings per share. I usually look at either the current PE or the forward PE, depending on the source. My second litmus test question is today's PE below or above its company's 5-year average PE? If the current PE is below the 5-year average, that could point to potential of undervaluation versus its historical pricing average, assuming the business itself is still solid. If the current PE is above the 5-year average, that could mean that the market is paying up and the stock might be more expensive than usual. I like this approach because it keeps the comparison within the company itself instead of trying to compare it to the overall broader market or some arbitrary rule of thumb. So my personal sweet spot here, I get really interested when today's dividend yield is higher than the 5-year average and today's PE is below its 5-year average. That combination tells me I'm getting more income than usual from the dividends, and I am not overpaying on the earnings basis compared to its recent past. The opposite setup, where the yield is lower than the average and the PE is higher than the average 5-year, usually means the stock is priced for perfection. A good example of that would be Costco. Costco is just priced for production. It's a great company, but you're paying a lot for those earnings. Again, this is not a rule that says buy or sell, but it's a useful litmus test that tells me which names are worth more of my time to investigate further. Let me show you two quick examples where I use this framework in real time. The first is Mastercard, ticker symbol MA, and second is VICI Properties, ticker symbol VICI, which is a REIT, Real Estate Investment Trust. Full disclosure, I own both of these in my long-term portfolio. This is not a recommendation to buy or sell either of them. I'm only using them to illustrate how I apply the Litmus test. Here, I'm looking at Mastercard on Simply Safe Dividends. On the left, you can see the dividend yield chart. The line across shows the 5-year average yield, and the dot to the right is the yield at the time I pulled this off the web. At this time, the Mastercard yield is above the 5-year average, even though it is still a low-yielding stock overall. That tells me either the price has pulled back, the dividend has grown, or faster than the price, or both. On the right, you can see the forward PE chart. The line is the 5-year average PE, and the dot to the right is where it was trading at the time I pulled this off the web. In this snapshot, the current PE is below the 5-year average. So we have the yielding above normal and the PE below normal. That is exactly the combination I like to see in my litmus test. More income, lower valuation versus recent history. On fast graphs, you can see a similar story from an earnings perspective. The black line is the price. The orange and blue lines represent fair ranges based on earnings and growth assumptions. I like to check whether the current price is below or near those fair value lines. Combined with the yield and P signal, this helps me see whether the recent pullback is giving me a more reasonable entry point or not. You can also see I marked the point in the past where it was trading below its historical PE ratio and what the rate of return would have been at the time I pulled this off the web, which is 16.9%. Now here's Mastercard again with fast graphs. And here I took the lowest point on the graph where it was at its very low and brought it out to the point when I pulled this off the web. And you can see the rate of return on this is 22.68%. Here we have VICI Properties, the REIT, on Simply Safe Dividends. The absolute numbers are very different. VICI is a high-yielding income play, but the logic is the same. Let's take a look at this. The yield at the time I pulled this off is 6.48%, which is quite a bit higher than the average 5-year average of 5.14%. And the price to AFFO, adjusted funds for operation, that's what you use when you use looking at REITs, is 11.5, which is quite a bit lower than the average 5-year average of 14.4%. VICI's yield is above its norm, and the valuation multiple is below its norm. This gets my attention as a potential opportunity, again, assuming the business fundamentals and the balance sheet are still sound. Now let's jump over to fast graphs and take a look at VICI Properties. As you can see with VICI Properties, it's traded above its price to AFFO and below its price to AFFO. I drew a line at one of the low points to one of the high points. That would have produced a 23.48% rate of return. Before we wrap this up, one important reminder. This litmus test is just the beginning of your research process, not your end. Once the stock passes the quick yield and PE screen, that's when I dig into the real work. Dividend history, dividend growth, cash flow, dividend coverage, the balance sheet, the story behind the stock, especially the dividend growth. So that's one I want to elaborate more on in future videos. This framework simply helps me sort dividend ideas into two piles. One worth studying deeper, the other ones I'm happy to skip at this point. It is not investment advice, and it does not replace full fundamental research, but it does keep me disciplined and consistent when I'm on the hunt for a dividend stock. If you found this helpful, please like the video and subscribe. Ring the bell for more SkiesCapital content, where we look at investing from 35,000 feet. Let me know in the comments, what's your litmus test? What do you like to use when you're evaluating the dividend stocks? Tell me what you think of this framework and what you'd like to see in the future. Thanks for watching, and remember, this is for educational purposes only, not investment advice. Have a great day.